Question 1. In California, what is the minimum free look period for a new life insurance policy? A. 7 days. B. 10 days. C. 20 days. D. 30 days. Answer: B. 10 days. The free look period, also known as the right to examine period, allows a policy owner to review a newly issued life insurance policy for a specified number of days and return it for a full refund of premiums if they are not satisfied. In California, the minimum free look period for most life insurance policies is 10 days, starting from the date the policy is delivered to the policy owner. This important provision ensures consumer protection by giving ample time to understand the policy's terms and conditions without financial penalty. Remember, the clock starts ticking when the policy is delivered, not when it's issued. Question 2. A life insurance policy's incontestable clause generally prevents the insurer from denying a claim based on misstatements in the application after the policy has been in force for a specific period, typically A. 6 months. B. 1 year. C. 2 years. D. 5 years. Answer: C. 2 years. The incontestable clause is a crucial provision that limits the time an insurer can challenge the validity of a life insurance policy based on material misrepresentations in the application. After the policy has been in force for 2 years, the insurer generally cannot deny a death claim due to misstatements by the insured, even if they were fraudulent, with some exceptions like non-payment of premiums. This clause protects beneficiaries by ensuring that claims are paid promptly after the policy has been in force for a reasonable period, preventing prolonged disputes. It essentially locks in the policy's validity after 2 years, offering peace of mind to policy owners. Question 3. Which of the following is considered a non-forfeiture option in a whole life insurance policy? A. Waiver of premium. B. Accidental death benefit. C. Extended term insurance. D. Guaranteed insurability. Answer: C. Extended term insurance. Non-forfeiture options are choices available to a policy owner who decides to surrender a whole life policy that has accumulated cash value. Extended term insurance allows the policy's cash value to be used as a single premium to purchase a paid-up term policy for the same face amount as the original whole life policy, for as long a period as the cash value can support. The other options listed are riders that add specific benefits to a policy, not choices for handling accumulated cash value upon surrender. Always remember that non-forfeiture options protect the policy owner's accumulated cash value if they stop paying premiums. Question 4. An insurer must notify the California Department of Insurance, CDI, of a producer's appointment within how many days of the agency contract date or the first insurance application submitted? A. 5 days. B. 14 days. C. 30 days. D. 45 days. Answer: B. 14 days. In California, an insurer is required to file a notice of appointment with the commissioner within 14 days from the date the agency contract is entered into or the first insurance application is submitted, whichever occurs first. This ensures that the Department of Insurance is aware of who is representing insurance companies and helps maintain regulatory oversight over licensed producers. The prompt reporting of appointments helps to ensure that producers are properly authorized to conduct business on behalf of the insurer. Question 5. The clause in a life insurance policy that states the policy and a copy of the application constitute the entire contract between the parties is known as the A. Incontestable clause. B. Insuring agreement. C. Entire contract clause. D. Collateral assignment clause. Answer: C. Entire contract clause. The entire contract clause stipulates that the life insurance policy document itself, along with a copy of the application attached to it, forms the complete and exclusive agreement between the insurer and the policy owner. This means that no outside documents, statements, or promises made by an agent are considered part of the legal contract unless they are physically attached to the policy. This clause is vital for preventing disputes over terms not explicitly written in the policy and attached application, ensuring clarity and finality regarding the agreement. It protects both the policy owner and the insurer by defining the exact scope of their contractual obligations. Question 6. All of the following are characteristics of a universal life insurance policy, except A. Flexible premiums. B. Adjustable death benefit. C. Fixed premium payments. D. Cash value accumulation. Answer: C. Fixed premium payments. Universal life insurance is known for its flexibility, allowing policy owners to adjust premium payments and death benefits within certain limits. Unlike traditional whole life policies, which typically have fixed premium payments, universal life policies allow for flexible premiums that can be increased, decreased, or even skipped, provided there is enough cash value to cover policy expenses. While universal life policies do accumulate cash value and allow for adjustable death benefits, fixed premium payments are not a characteristic of this type of policy. Question 7. The Medical Information Bureau, MIB, serves what primary purpose in the underwriting process for life insurance? A. It provides medical treatment for applicants. B. It collects and shares confidential medical records from doctors. C. It is a non-profit organization that provides insurers with coded information about applicants' health history. D. It acts as a clearinghouse for genetic test results. Answer: C. It is a non-profit organization that provides insurers with coded information about applicants' health history. The Medical Information Bureau, MIB, is a non-profit trade organization that provides insurers with a system to detect and deter fraud by collecting and sharing coded information about individuals' past health impairments or hazardous activities as reported by other member insurance companies. The MIB helps insurers quickly identify inconsistencies or material misrepresentations made on insurance applications. It does not provide medical records, but rather summarizes information that might indicate an applicant failed to disclose significant health details, thereby helping in the underwriting process to ensure fair and accurate risk assessment. Question 8. In California, what is the maximum interest rate an insurer can charge on a policy loan for a life insurance policy issued on or after January 1, 1982? A. 6%. B. 8%. C. 10%. D. No maximum, varies by insurer. Answer: B. 8%. For life insurance policies issued in California on or after January 1, 1982, the maximum fixed interest rate an insurer can charge on a policy loan is 8% per annum. Alternatively, a variable interest rate may be used, but it must conform to specific actuarial standards. This regulation protects policy owners from excessively high interest charges when borrowing against their policy's cash value. Knowing this specific percentage is crucial for understanding the financial aspects of policy loans. Question 9. Which rider on a life insurance policy would pay a specified amount for each day the insured is confined to a nursing home facility? A. Waiver of premium rider. B. Long-term care rider. C. Accidental death benefit rider. D. Guaranteed insurability rider. Answer: B. Long-term care rider. A long-term care rider allows the policy owner to accelerate the death benefit from their life insurance policy to cover costs associated with long-term care, such as nursing home confinement or home health care. This rider provides a valuable benefit that can help pay for expensive care needs while the insured is still alive, essentially using a portion of the death benefit for living benefits. The other riders mentioned provide different types of benefits, such as waiving premiums, increasing death benefits for accidental death, or allowing future coverage increases without proof of insurability. Question 10. A policy owner has an existing life insurance policy and is encouraged by an agent to cancel it and purchase a new one. primarily to generate a new commission for the agent, without a clear benefit to the policy owner. This practice is known as A. Twisting, B. Churning, C. Rebating, D. Coercion. Answer: B. Churning. Churning occurs when an agent replaces an existing life insurance policy with another policy in the same company, primarily for the purpose of generating a new commission without a legitimate and justifiable benefit to the policy owner. This practice is unethical and illegal because it often leads to financial detriment for the policy owner, as they may incur new surrender charges or lose valuable benefits from their original policy. Understanding the difference between churning, same company, and twisting, different company, is important for ethical conduct. Question 11. Which life insurance policy option allows the policy owner to pay an additional premium and receive additional coverage at specific future dates without proving insurability? A. Cost of living rider, B. Guaranteed insurability rider, C. Payer benefit rider, D. Accidental death benefit rider. Answer: B. Guaranteed insurability rider. The Guaranteed Insurability Rider, GIR, is a valuable addition to a life insurance policy, granting the policy owner the right to purchase additional amounts of insurance coverage at predetermined future dates or specified life events, like marriage or birth of a child, without the need for further evidence of insurability. This means the insured's health status at the time of future purchase does not affect their ability to acquire more coverage. This rider is particularly beneficial for younger individuals who anticipate future financial growth or family expansion. Question 12. All of the following are examples of how policy dividends may be used, except A. Applied to reduce the next premium payment, B. Paid out in cash, C. Used to purchase a new policy with a higher face amount, D. Left with the insurer to accumulate at interest. Answer: C. Used to purchase a new policy with a higher face amount. Policy dividends, which are a return of unused premiums from a participating life insurance policy, can be utilized in several ways: paid out in cash, applied to reduce future premiums, left with the insurer to accumulate interest, or used to purchase paid-up additions. While paid-up additions increase the policy's face amount, they are small increments to the existing policy. Using dividends to purchase an entirely new policy with a higher face amount is not a standard dividend option. Remember that dividends are not guaranteed and are typically paid only on participating policies. Question 13. Which statement about the tax implications of life insurance death benefits in California is generally true? A. Death benefits are typically taxable as ordinary income. B. Death benefits are generally received income tax-free by the beneficiary. C. Death benefits are always subject to estate taxes. D. Death benefits are taxable only if paid in installments. Answer: B. Death benefits are generally received income tax-free by the beneficiary. One of the significant tax advantages of life insurance is that the death benefit proceeds paid to a named beneficiary are generally received income tax-free. This means the beneficiary does not have to report the lump sum payment as taxable income. While large estates might face estate taxes, the death benefit itself is not considered taxable income for the beneficiary under federal income tax law. This tax-favored treatment makes life insurance a powerful tool for wealth transfer and financial protection. Question 14. An individual who holds a life-only agent license in California is authorized to transact A. Only term life insurance, B. Life insurance and annuities, C. Life insurance, annuities, and disability insurance, D. Life insurance, annuities, disability insurance, and long-term care insurance. Answer: B. Life insurance and annuities. In California, a life-only agent license authorizes an individual to transact all forms of life insurance coverage, which includes various types of life insurance policies as well as annuities. This license does not, however, authorize the sale of disability insurance or long-term care insurance as standalone products, which typically require an accident and health license. Understanding the specific authority granted by each license type is critical for compliance, and insuring agents only sell products they are legally authorized to. Question 15. The grace period in a life insurance policy typically allows the policy owner how many days after the premium due date to pay the premium without the policy lapsing? A. 7 days. B. 15 days. C. 31 days. D. 60 days. Answer: C. 31 days. The grace period is a crucial provision in a life insurance policy that provides a safety net for policy owners who might be late with a premium payment. It typically grants a 31-day period following the premium due date during which the policy remains in force, even if the premium has not been paid. If the insured dies during this grace period, the death benefit will still be paid, but the unpaid premium will be deducted from the payout. This provision ensures that coverage doesn't immediately lapse due to a slight delay in payment. Question 16. What does insurable interest mean in the context of life insurance? A. The policy owner must be a relative of the insured. B. The policy owner must expect to suffer a financial loss if the insured dies. C. The policy owner must be the primary beneficiary. D. The insured must be in good health. Answer: B. The policy owner must expect to suffer a financial loss if the insured dies. Insurable interest means that the policy owner, or beneficiary, must have a reasonable expectation of suffering a financial loss if the insured individual dies. This financial or economic tie must exist at the time the policy is purchased, ensuring that life insurance is not used for speculative or wagering purposes. Examples include a spouse insuring a spouse, a parent insuring a child, or a business insuring a key employee. Without insurable interest, a life insurance contract would be considered void as a gambling contract. Question 17. Which of the following is not a typical characteristic of a variable life insurance policy? A. Fixed, guaranteed rate of return on cash value. B. Cash value that fluctuates with investment performance. C. A minimum guaranteed death benefit. D. Requires a securities license to sell. Answer: A. Fixed, guaranteed rate of return on cash value. Variable life insurance policies feature cash values that are invested in separate accounts, and their performance directly impacts the cash value and potentially the death benefit. Unlike whole life insurance, which offers a guaranteed minimum cash value growth, variable life does not guarantee a fixed rate of return on its cash value. Its growth fluctuates with the underlying investment performance. Because of the investment risk and the fact that they are considered securities, variable life policies require both a state life insurance license and a FINRA securities license to sell. Question 18. If a life insurance policy lapses due to non-payment, the reinstatement provision typically allows the policy owner to reactivate the policy by doing all of the following, except: A. Paying all back premiums with interest. B. Proving insurability. C. Paying a new initial premium without proving insurability. D. Repaying any outstanding policy loans with interest. Answer: C. Paying a new initial premium without proving insurability. The reinstatement provision allows a policy owner to restore a lapsed life insurance policy, typically within a specific time frame, example 3 to 5 years, after it has lapsed. To reinstate, the policy owner must generally pay all back premiums with interest, repay any outstanding policy loans with interest, and provide evidence of insurability, prove they are still a good risk. The goal is to bring the policy back to its original status, not to start a new policy with a simple new premium. This provision is beneficial because it avoids the need to purchase a new policy at an older age or with new health issues. Question 19. A life insurance policy's cash value loan feature allows the policy owner to: A. Borrow against the death benefit without reducing it. B. Receive a portion of the death benefit while the insured is still alive. C. Borrow money from the accumulated cash value of the policy. D. Pay premiums with a loan from the insurer. Answer: C. Borrow money from the accumulated cash value of the policy. The cash value loan feature allows the policy owner to borrow funds directly from the accumulated cash value of their permanent life insurance policy. This is not a loan from the insurer in the traditional sense, but rather an advance on the policy's own value, with the cash value serving as collateral. If the loan is not repaid by the time of the insured's death, the outstanding loan amount and any accrued interest will be deducted from the death benefit paid to the beneficiaries. This feature provides a flexible and often tax-advantaged source of funds for the policy owner. Question 20. In California, if an agent uses the term financial planner in their advertising, what must they include? A. Their license number. B. A disclaimer that they are not a licensed investment advisor. C. Their full legal name and the name of the insurer they represent. D. A statement that they are licensed as a life-only agent or an accident and health agent. Answer: D. A statement that they are licensed as a life-only agent or an accident and health agent. In California, if a life insurance agent uses a professional designation or a term like financial planner that implies they are engaged in providing financial advice, they must also clearly state their license type, such as licensed as a life-only agent or licensed as an accident and health agent. This regulation ensures transparency and prevents consumers from being misled about the scope of an agent's expertise or licensing. It clarifies that their primary license is in insurance, not necessarily in broader financial planning or investment advising. Question 21. Which type of beneficiary designation ensures that if a named beneficiary dies before the insured, their share will pass to their living descendants? A. Per capita. B. Per stirpes. C. Revocable. D. Irrevocable. Answer: B. Per stirpes. The per stirpes, meaning by the roots, beneficiary designation ensures that if a named beneficiary predeceases the insured, that beneficiary's share of the death benefit will then be distributed equally among their living children or descendants. This method contrasts with per capita, where the death benefit is divided equally among only the surviving named beneficiaries. Per stirpes ensures that the bloodline of the original beneficiary is maintained in the distribution of benefits, providing a structured inheritance plan. Question 22. What is the primary purpose of the California Department of Insurance, CDI? A. To represent the interests of insurance companies. B. To promote competition among insurers. C. To protect the public interest by regulating the insurance industry. D. To provide insurance coverage to California residents. Answer: C. To protect the public interest by regulating the insurance industry. The primary purpose of the California Department of Insurance, CDI, is to protect the public by regulating the insurance industry in California. This involves ensuring that insurers are financially solvent, that producers are qualified and conduct business ethically, and that consumers receive fair treatment and have access to appropriate insurance products. The CDI oversees compliance with state insurance laws, investigates consumer complaints, and approves policy forms and rates. Its role is strictly regulatory and consumer-focused, not to provide insurance or solely promote competition. Question 23. A temporary insurance agreement that provides coverage from the date of the application if a premium is submitted with the application and the applicant is found to be insurable is called A. Binding receipt. B. Conditional receipt. C. Temporary certificate. D. Interim binder. Answer: B. Conditional receipt. A conditional receipt is a type of temporary insurance agreement that provides immediate coverage to an applicant from the date the application is signed and the first premium is paid, provided the applicant is found to be insurable according to the insurer's underwriting standards. If the applicant dies before the policy is issued but while the conditional receipt is in effect and they would have been insurable, the death benefit will be paid. This receipt makes the coverage conditional upon the insurer's approval of the risk. Question 24. A policy owner decides to replace an existing life insurance policy. In California, which of the following is an obligation of the replacing insurer? A. To automatically approve the replacement without review. B. To notify the existing insurer of the replacement. C. To waive all underwriting requirements for the new policy. D. To pay any surrender charges on the existing policy. Answer: B. To notify the existing insurer of the replacement. When a life insurance policy is being replaced in California, the replacing insurer has specific obligations designed to protect the consumer and ensure transparency. One key obligation is to notify the existing insurer of the replacement, which allows the existing insurer to contact their policy owner and explain the potential disadvantages of replacement, such as new contestability periods or surrender charges. This notification process helps prevent unfair or unnecessary policy replacements, ensuring the client makes an informed decision. Question 25. What happens to the death benefit of a life insurance policy if the insured dies by suicide within the first 2 years of the policy's effective date, assuming a standard suicide clause? A. The full death benefit is paid to the beneficiary. B. The insurer will pay the face amount less any outstanding loans. C. The insurer will refund the premiums paid, without interest. D. The policy is voided, and no money is returned. Answer: C. The insurer will refund the premiums paid, without interest. Most life insurance policies include a suicide clause, which states that if the insured commits suicide within a specified period from the policy's effective date, typically 2 years in California, the insurer will not pay the death benefit. Instead, the insurer's liability is limited to a refund of the premiums paid. This clause is designed to prevent individuals from purchasing a policy with the intent of committing suicide shortly thereafter. After the 2-year period, the suicide clause generally expires, and the full death benefit would be paid.